Hello, and welcome to the Mortgage Solutions Homebuying 101 online class. My name is Dave Tallman, and I'm the owner of Mortgage Solutions of Georgia, and I hope that you get a lot of great value from this course. A little bit about myself. I've been in the residential financing space for over 20 years. I'm also an FHA DE underwriter, and what I love most about my job is being able to help first-time home buyers purchase their first home. I was raised by a single mother in a very rural part of northeastern Ohio. We didn't have much growing up, but what we did have was a home. And for that, I'm very, very thankful. My mother worked at a local savings and loan bank in our small town. At a very early age, I remember my mom taking me to work with her where I would play with my little boy toys under a large unused conference table while my mother worked. And one of the things that really resonated with me as a young child was watching all of the farmers and factory workers come into the bank for loans and being able to watch my mom help them. Times were different back then, and business was certainly done differently back then, but it was all about helping people and helping families within our community. And that's what we really try to do here at Mortgage Solutions of Georgia. So, with that, let's get you started on your journey. The objectives for this course are going to be number one, discover the benefits of home ownership. Number two, we're going to understand what being pre approved means and what impacts this process. Three, we're going to take a look at some various loan programs that you might be interested in learning more about. And then lastly, we're going to understand the first steps towards home ownership. So I always like to start these courses with the benefits of home ownership. You are considering taking a step forward for your family and your financial health. And for some of you, buying a home might be a financial decision, while for others, it might be more of an emotional decision. And there's no right or wrong because they're both equally important. But let's get into some of the benefits to buying a home. So why would we want to purchase a home instead of renting? Well, number one, when you buy a home, you can build equity. See, unlike a rental property where you just pay your $1,500 a month and you don't really get anything for that other than a place to stay, when you buy a home, you're able to build equity in that home. And you build equity through two things. One, your home is going to appreciate in value. We'll have a little bit more on this topic in just a few minutes. But also, you're going to be paying the loan balance down every time you make a mortgage payment. So, the number one reason, financial reason for you to buy a home is because you can build equity. Home ownership increases personal wealth through mortgage payments and property value appreciation, creating a financial asset for future use. Number two, stability and control. Owning a home offers stability and the freedom to customize your space, enhancing satisfaction and fulfillment. And lastly, predictable, stable monthly payments. Fixed rate mortgages ensure consistent mortgage payments, aiding financial planning, unlike fluctuating rental housing prices that can lead to significant financial strain. All right, let's talk about building wealth through homeownership through appreciation. So, owning a home is the number one thing that you can do to build your net worth. Let's talk about some numbers. So, as I'm recording this, we just finished up the third quarter of 2024. And according to the most recent data that was just published, the annual rate of home value appreciation for the state of Georgia is right at 6%. Now, I would suspect that this is going to continue to climb with lower decreasing mortgage financing rates. This is going to bring a lot of pre approved buyers onto the market, which is going to fuel home appreciation. But let's just take a look at this example. If you were to buy a home today for, say, $200,000 and using our 6% annual rate of appreciation, in year one, you would pick up $12,000 of equity. So the same home that you could purchase today for 200,000 in 1 year from now will actually cost you 212,000. Now, if we run this 6% annual appreciation calculation over, say, the course of 5 years, that same $200,000 loan home that you could purchase today is in 5 years from now, using just 6% annual appreciation, will actually cost you $252,495. And if we look forward 10 years from now, that same $200,000 home 10 years from now will actually cost you $337,893. So you have to ask yourself, if I'm renting today and maybe I'm renting a home for $200,000, am I going to pick up this additional equity of 130, roughly $138,000? And the answer is no, because you don't own it. And this is one of the number one things that renters should look at and consider when they're buying a home, is the impact of mortgage appreciation combined with reducing the loan balance through regular scheduled monthly payments. So the pickup over a 10-year duration of time on a $200,000 home is almost $138,000 of home value appreciation that you as a potential home buyer would gain. Whereas if you're just continue renting, you will certainly not gain that because you don't own the home. So that's just one example of the power of home appreciation and how buying a home can help you build wealth quickly. Number two, better health and stability. Benefits of homeownership include enhanced life satisfaction and psychological health, lower exposure to crime, higher rates of civic involvement, and better school performance. Guys, the studies are all over the internet of the positive impacts that homeownership has, not just for you as an adult and or as a parent, but also significant improvements in education and psychological benefits for your children. And I'll just, a lot of times when I'm talking to first time home buyers, um, I want to paint the picture for them, right? I mean, we all remember our childhood homes, and many of us have moved around between the ages of, kindergarten and high school. Maybe our parents moved around and maybe they owned two or three homes. But for the vast majority of us, we all remember that one home that we consider to be our childhood home. So the emotional side of this, the emotional side of the purchase is, you know, we as parents want to create those same memories of having our childhood home for our children as well. But you can Google online all of the psychological benefits for home ownership, for not just yourself, but also your children. Children of homeowners are more engaged in their education process. They get better grades in school, and it's just all around good for not just you as the adult and the home buyer, but also for your young children. Okay, what does pre-approved mean? There is a difference and between being pre-approved versus pre-qualified. Now, although this verbiage sounds very similar, there is a vast difference. So, um, a pre-qualification means that it's you're on the infancy stages of pre-approval. So maybe you've had a conversation with a financial consultant or a loan officer. Maybe you've reported what you make, what your debts are, what you think your credit score is. So basically a pre-qualification is not a pre-approval. It's basically you've had a conversation. um, in our mortgage world and in a highly competitive mortgage market, almost nobody does pre-qualifications anymore. What you really want to do is seek to get pre-approved. And the pre-approval process is a little bit more formal and little bit more of a thorough evaluation where we're actually reviewing your pay stubs, your W-2s, your tax returns, your bank statements, and we've performed a credit check. So this is a much more engaged process. It's you actually taking the next step and raising your hand and saying, "Hey, I'd like to be a homeowner." Okay, this is a very, very critical part of the home buying process, and it's actually one of the very beginning stages because the pre approval process is critically important because it kind of outlines and sets the path forward for, hey, I want a $1,600 mortgage payment, and that's the most that I could ever go on the perfect home. Well, if you've got a 15 or a $1,600 budget, we're not going to go out and show you homes that are $400,000 and $500,000. So it kind of sets the tone, and it makes sure that the time that you spend with your realtor is very efficient by allowing us to do a pre-approval for you, and you being very open and honest with us in terms of, this is where I really need to have my monthly payment. It allows us to kind of set the course for only showing you homes that are within that certain criteria for your budget. It also separates you from the crowd because there will still be some people who try to put an offer in a home who are not actually pre approved. And very rarely, a very small percentage of those home buyers actually get their offer accepted. I would say upwards of 90% of home sellers fully expect the home buyer to be pre approved prior to putting in an offer. It just makes sense at the end of the day because you, as the prospective home buyer, we got to know what our numbers look like. We got to know monthly payments. We got to know if there's any sort of down payment that's going to be expected of us. So let's get into the pre approval process and some of the factors that can impact your pre approval. So, the first of which is your credit history. Um, so, as many of you know or may not know, everybody who utilizes credit typically is going to have three scores. One score from each credit repository, which are Equifax, TransUnion, and Experian. And all three of those scores are likely to be a little bit different. And for purposes of you being pre approved, we are typically going to be using your middle score. So, we're going to roll out your high score, we're going to roll out your low score, and your pre-approval and pricing is going to be based on your middle credit score, regardless of what credit bureau that is. Okay. You have to understand the reasoning that we are reviewing your credit and the reason why a mortgage lender is interested in your credit. What we're trying to get the feel for is, hey, Mr. or Mrs. Homebuyer, if we loan you two or $300,000 to go out and buy your first home, what's the likelihood that we're going to get repaid or get our money back? So specifically, we're looking for a couple of things on your credit report. The number one thing that we're looking at is your payment history. I mean, that's pretty easy. That's, do you pay your bills on time? In fact, about 35% of your credit score is derived from, do you pay your bills on time? So that's the first thing that we look at. The other thing that we're looking at is your percentage of use. So your percentage of use looks at how much credit is available for you to use and how much of that credit are you actually utilizing. So, for example, if you have a credit card that has $1,000 credit limit and your balance is sitting at $900, well, then that means that your percentage of use is 90%. And guys, you may or may not know this, but that's the point of this seminar. But any percentage of use over 30% is not good for your credit scores. So the magic number for maximizing your credit score improvement on a monthly basis is 30%. We want to make sure that um, prior to seeking pre-approval that we do our best to work our credit balances down below 30% threshold. That way, when we do seek pre-approval, we're working with the highest and best scores. The other factors that affect your credit score would be if you have any new credit, the length of your credit history. So how long have you had credit? So we like to call it credit depth. So if you've had a credit card for 10 years and an auto loan for 3 or 4 years, then you've got good credit depth versus maybe somebody who just opened up their first credit card a couple of months ago and they've only got a couple of months reviewed. Um, Credit scoring can range anywhere from 300 to 850. Less than 1% of the American population has scores in the 800s. A good workable credit score is generally somewhere in the mid 600s. Low 600s would be considered low credit, but still possible for mortgage financing. For most all loan programs, you are going to need a minimum credit score of 580 and above. Okay. The other thing that we look at for the pre-approval status is your employment status. So, you know, are you working? What does your income look like? What does your other debts look like? Because this determines an applicant's debt ratio. Your debt ratio looks at how much money you make compared to how much money you spend, including a new mortgage payment. Okay. So, for example, if you make, say, $5,000 a month, but you've got $2,500 in monthly minimum debt payments, including a new mortgage, then your debt ratio would be 50%. Okay. So a 50% debt ratio is okay on a lot of different loan products, although it's a little bit high. Okay. And it's important to understand that credit score and debt ratio, these are the two biggest factors that we're looking at as mortgage loan officers when it comes time for pre approval. And it's also important to note that the different loan programs will have different tolerances for an applicant's debt ratio. So, for example, like a VA loan, for example, for veterans, they don't have per se an acceptable debt ratio. I've seen veterans get an approval with debt ratios of 60, 65%, but that is a very extreme level. Most of the time, we would like to see a debt ratio of at least 44% or below. However, FHA does, for example, allow for a debt ratio of up to 56.9%. USDA allows for a back end debt ratio of up to 44%. So each and every loan program that you may consider as a first time home buyer has different tolerances for what they will look at in terms of debt ratio. Okay. Um, okay. Let's talk about what your mortgage payment includes, what it consists of. So, the typical mortgage payment consists of four amounts known as PITI. That stands for principal, interest, taxes, and insurance. Okay. If you have less than a 20% down payment, you're also likely going to be paying private mortgage insurance, which is also added to your monthly mortgage payment. But let's talk about each of these a little bit. So, principal and interest portion of your mortgage payment. So, the principal portion of your mortgage payment is the amount that you pay that actually goes towards reducing your loan balance. The interest portion is interest which is owed on the loan. So, every time you make a mortgage payment, a part of your mortgage payment is principal and interest. And just it goes, I need to probably repeat it again. The principal portion is used to reduce the amount that's owed on the mortgage loan. The interest portion does not go towards reducing the loan balance. It's just interest that's owed from you to the bank on the loan. Okay. Uh, Taxes and insurance is the next two. So most first-time home buyers loans are going to require that you escrow your taxes and insurance. And when I say the word escrow, all that means is that that every time you send in a monthly mortgage payment, part of your payment is going to be 1 month of taxes and 1 month of homeowners insurance. And the point of escrowing is that the lender or your mortgage servicer is responsible for paying the property taxes and the homeowner's insurance when those bills come due. So your total monthly payment will consist of principal, interest, taxes, and homeowners insurance for the property. So we're going to give you an all inclusive monthly mortgage payment. Okay, how much can I afford? This is a great question, and this is one of the top questions that we end up answering when you seek pre approval and you submit a loan application, and we begin the process of working with you. So, lenders use your debt to income ratio to determine the loan amount that you may qualify for. Again, your debt ratio is determined by how much money you make compared to how much money you spend. So, to determine how much money you're spending, and that spend includes the projected monthly mortgage payment for the home that you're looking to buy. So, you could have minimum payments on two or three credit cards. You could have an auto loan payment. You could have some student loan payments, and we're looking at all of those minimum payments and we're dividing it out by your monthly gross income. We use gross income when determining this factor. So we're not concerned with what's actually being directly deposited into your bank from a direct deposit from your employer. We're more concerned with the gross earnings. What are you earning prior to taxes coming out of your check? Okay. And again, as I previously said, debt ratios can be variable depending upon the loan program that we're trying to pre qualify you for. So, for example, a USDA loan, which will give you 100% financing, they're going to be a little bit more restrictive on an applicant's debt ratio. Whereas another commonly used first time home buyer program, the FHA program, they're going to be much, much more flexible on an applicant's debt ratio. Okay, so loan programs. Which loan is right for you? Let's get into a little bit here. There are um, three or four different kinds of loan programs, and there are some specialty loan programs. The first one that I want to talk about is the USDA program. Okay, USDA is tremendous financing because it offers approved applicants 100% financing. Okay, the USDA loan. When we think of USDA, we oftentimes think of like meat products and farm stuff. Okay, but USDA is a government entity, and they've kind of got their hands in a lot of different areas. One of those areas being home ownership. And so one of the products that the USDA has their hands in is trying to stimulate housing in geographical rural areas. So a USDA loan is not eligible in every county in the state of Georgia or Alabama or Florida, but in Georgia specifically, there are a lot of counties that are 100% eligible for USDA loans. And then there are some counties that have areas of eligibility or pockets, if you will, of USDA eligible areas. And if I look in this on the map, USDA map for the state of Georgia, there's only about 7 or 8 counties in the entire state of Georgia that are not at all eligible, have no eligible areas for USDA availability. The USDA looks at um, availability in regards to how densely populated a given area is. So areas around like Metro Atlanta, Fulton, Cobb, Gwinnett, where there are a lot of people, a lot of big businesses, those are not going to be eligible areas for USDA. If I look around the map, like Richmond County over by Augusta, there's a lot of people there. Muskogee County in Columbus, Georgia, Macon, which is in Bibb County. These are counties that have a lot of big industries. Some of them have military bases, which adds to the population count. But these are some of the counties that are going to have no eligibility whatsoever for USDA. But The other thing to consider too, USDA has geographical restrictions, but they also have income limitations. The income limitations for USDA works on a sliding scale depending upon how many people, including children, are going to be residing under that particular roof. So the more individuals, children including, that are going to be residing underneath that roof, that increases the income limit. But it is important to note that um, if you say I've got a husband and a wife, and maybe only the husband's applying for the USDA loan, but the wife works as well, even if the wife is not on the mortgage loan, the USDA program will still review her income just to ensure that as a household, the home is not exceeding the USDA income limit. Okay, so that's really important to note. So the high notes on USDA, it is tremendous financing. It's generally option one for our home applicants who are looking to purchase their first home. It does offer 100% financing. It is a little bit more of a challenging loan to get closed because the underwriting process is pretty thorough. They really cross every T and dot every I. There are geographical restrictions, there are income limits, but top to bottom, it is common sense underwriting and it's really, really great financing. So definitely a loan that we would consider very high on the list. The second loan that we oftentimes look at for first-time homebuyers is an FHA loan, and FHA is a really, really great financing, and it was actually specifically designed in the mid '70s by HUD for first-time homebuyers. Now, I will tell you that the financing for FHA loans is so good, and even though this program was actually designed for first-time homebuyers, I have a lot of repeat clients who utilize the FHA program over and over and over again because it allows you to buy a home with a little smaller down payment, and it's a very, very flexible in terms of underwriting. So it allows for lower credit scores, it allows for higher debt ratios, it also allows for manual underwriting, which is a big benefit. Um, so just a little bit of guidance behind the FHA program. FHA is always typically going to require a minimum down payment of 3.5% of whatever your sales price is. We do here at Mortgage Solutions of Georgia offer some down payment assistance programs, which we can double with an FHA loan product, which will essentially give you 100% financing. But I will also tell you that anytime we add a down payment assistance program to an FHA loan, it oftentimes comes with a little bit of a higher interest rate and a little bit of higher closing costs. So we always recommend that if you can come up with your own down payment, you do so because your financing will be a little bit better that way and your monthly mortgage payments will be a little bit better that way. But one of the other reasons why the FHA loan program is so popular, there's actually two reasons. The first reason is that if you don't have a down payment, FHA will allow a family member or a close friend or a relative to actually gift you the down payment for your for gift you the funds for your down payment. So in other words, maybe you would like to buy a home, you're pre-qualified for the FHA loan, and your only stopping point is, well, Dave, I don't have the 3.5% down payment. Well, you can have mom or dad or grandma or grandpa, brother, sister, whoever in your family actually gift you those funds. There's no penalty for doing so, and the FHA program allows that to occur. So you can get yourself pre-qualified for an FHA loan, and you yourself don't even have to have the down payment. It can actually be gifted to you by anyone in your family or a close family friend or a church or an employer. The down payment can virtually come from anyone who's willing to gift it to you. The second reason why a lot of people really like the FHA program is because it allows for what we call in the industry a non occupying cosigner. So A non-occupying cosigner would be somebody who would be co-signing on the loan with you in order to help you qualify for said mortgage loan, but maybe is not necessarily going to live in the property with you. Okay. So an example of this would be like, hey, I just graduated school. I'm pretty early on into my job. Maybe I'm not, making quite enough to qualify for the loan that I'm looking at, trying to qualify for the home that I'm trying to purchase. We can actually add mom or dad or both onto the loan with you to help you qualify for that mortgage loan. So it allows us to add maybe a more seasoned buyer onto the mortgage loan with you. By doing that, we can pick up their income. We also pick up their debts. But the idea here is that the non-occupying cosigner is someone who's pretty well qualified, has good scores, and we can utilize their income and their scores to kind of help get a loan approval for yourself. From time to time, we're also going to be using a non-occupying cosigner potentially to help with maybe somebody, an applicant who's got lower scores. Okay. Sometimes we'll bring in a non-occupying cosigner. Again, could be a mom, a dad, a grandparent, somebody who's got really good scores to kind of shore up the deal and help over trump maybe low to moderate credit scores that you yourself may have. So a lot of great flexibility on the FHA loan program to consider. Of course, if you're in a USDA eligible area, we're going to look at that loan program first because that's going to give you 100% financing right out the gate. But if that program doesn't meet your needs, then the other option, great option, is FHA. And I would say that these two programs are equal with all things considered. The other loan that we're going to take a look at today and talk a little bit about is a VA home loan. So briefly, VA loans are for our wonderful military personnel who have served time and have gained their certificate of eligibility through the VA, which signifies their ability to do a VA loan. VA loans are wonderful loan products. They are the best financing product on the market. If you are not a veteran, you are not eligible for this product. This product is only for veterans. But the VA loan allows qualified veterans to purchase a home with no money down. So you get 100% financing. You also have no monthly mortgage insurance. And if you have any sort of disability rating, just as little as 10%, it negates any sort of VA funding fee for qualified vets. The VA underwriting is super generous. It's very, very flexible. So you do not have to have perfect credit whatsoever, provided that you are a veteran. A VA loan is the number one choice. Okay. Some additional specialty products that are out there on the market. There are some conventional loan products that will allow a first-time home buyer. And just as a side note, so we're all on the same page here, a first-time home buyer is classified as anyone who has not owned a home in the most recent 3 years. Okay, so if you haven't owned a home in the past 3 years, for all intents purposes, you can be considered as a first-time home buyer. There are some conventional loan products out there on the market that are specifically geared for first time home buyers. The conventional product that I'm thinking of right now is called the Home One program. It's a 97% financing program, so it does require 3% down. Um, if you are in a low to moderate income household family, then there are some other perks with lower monthly mortgage insurance rates, lower interest rates on these products. Generally speaking, conventional loan products are going to want higher credit scores. Okay. So if you seek pre approval and you've got a higher credit score, generally 680 and above, this might be one of the loan products that we look at. But for us here at Mortgage Solutions, we really want to work with you and educate you up on all of the available loan products that are available to you. So oftentimes, what we will do is we will If you are eligible for multiple different products, we're going to line item each of those products out. We're going to put them right in front of you, show you the benefits and positives to each one of those programs, and then together we will make an educated decision. Okay, so you want to buy a home. Where do I start? That's the next question. Well, the number one thing that you've got to understand is that not all mortgage lenders are created equally. You really want to work with someone who's trustworthy, who you feel like can get you from point A to point B. You really want to work with someone who can lead you very well in the process. You really want to work with somebody who's got a great local reputation in the market, and you really want to work with somebody who you feel has your best interest at heart. Um, so I would definitely take some time and I would have some conversations with two or three lenders. Ask them questions. Ask them, how long they've been in the business for, what kind of credentials that they have. Ask them some tough questions so that you can get a feel for how competent they are, how knowledgeable they are, and everything like that. You really got to do your due diligence, because what I have found with some of my clients is that uh, being pre-approved with the right company can oftentimes be the difference between you winning a bid and not winning a bid. We've got a great reputation in the market, and we've been in business for over 20 years now. And and I've actually had realtors tell me, Dave, your client didn't have the highest and best offer, but I encouraged my seller to take your client's offer anyways, because we know mortgage solutions. We know the quality of work that your organization does. And so I recommended to my seller that they take your client's offer, even though it wasn't the highest and best. So it's not so much that you are pre approved. What's probably more important in today's highly competitive market is who you're pre-approved with. Okay, so that's critically important. And then the other thing I will tell you is that you're not seeking a pre-qualification. You're seeking a full-fledged pre-approval. you know um, in our industry, time is money, and into your realtor, time is money. A pre-qualification in today's mortgage world and real estate world really doesn't mean anything whatsoever, and you're certainly not going to make a seller feel real comfortable with your offer if you're simply pre-qualified. Which, again, going back earlier in this course, a pre-qualification is essentially you've had a conversation with a bank or with a loan lender. They have not reviewed your credit. They have not looked at your income documents or your asset documents. And I would just really encourage you, to take that next step. It's not, uh, there's nothing to really be nervous about. And oftentimes, what I tell our applicants is, hey, um, when you apply with us for at Mortgage Solutions of Georgia, we want you to complete the application, and then what we're going to do on our side is we're going to do what's called a soft credit check. And there's a difference between a soft credit check and a hard credit inquiry. Okay, a lot of people don't want to complete the pre-approval process because they don't want their credit checked, because they feel like their scores are going to be negatively impacted by that credit inquiry. So what we do here at Mortgage Solutions is we alleviate that concern. When you seek pre-approval with us and you complete the application online, we do what's called a soft credit check. And as a soft credit check, we're going to see two of your three credit scores, and we're going to get an idea of your debt load, but it does not count as a hard credit inquiry. So it has no bearing whatsoever on your actual credit score. Okay. So what I always tell my clients is, seeking pre-approval with us, nothing bad can come out of that. And it's all positive news that can come out of that, because the outcome of that pre-approval or that mortgage application is going to be one of two things. Best case, I say, hey, congratulations, Mr. and Mrs. Homebuyer, you're officially pre-approved. We can help you. Here's some loan options, and let's go find you a great house, and happy house hunting, right? Conversely, the other conversation can be, Hey, Mr. and Mrs. Homebuyer, right now your scores are a little bit low, but the good news is I've created you a custom plan, credit plan for you to follow. And if you follow this plan in 2 months from now, in 3 months from now, in 6 months from now, or heck, it may be a year from now, you will be a homeowner. So the outcome of a mortgage application with our entity, and I can't speak for the way any other companies conduct business. But for our business here at Mortgage Solutions of Georgia, every client, every application is critically important, and we're gonna treat you just the way that my mom treated the local factory workers and farm workers at her savings and loan bank. We're gonna treat you with respect. We're gonna treat you with care and love and dignity, and you're gonna get great value from seeking pre-approval with Mortgage Solutions of Georgia because it's going to be a win-win for you. Either you're going to win by your pre-approved, congratulations, let's go find you a house, or you're going to win because we're going to take the time to educate you up on what's important credit wise. And moreover, we're going to create you a custom plan that's going to get you from point A to point B. So I hope that you've enjoyed this. I'm sure that you may have additional questions for me. And if you do, um, there'll be a QR code at the end of this or on this web page here that you can scan with your phone, and you can book right into my calendar for a 15-minute talk, and I'll be more than happy to jump on the phone with you and answer any questions or concerns that you may have. So with that, I wish you the best of success, great luck here moving forward, and if there's anything at all that myself or my team can do to help you with this journey, we would be honored to earn your trust and to be able to work with your family. Take care.